Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, October 22nd, 2025. As always, we'll start with the executive summary from today's leadoff morning note. So let's hop right into it. Today's key macro question is, what do the corrections in gold and crypto signal about the durability of our paradigm C bull market? The short answer is not much. Corrections are normal in bull markets. Our analytical nuance suggests gold extended its slide in volatile trading as spot prices fell below 4,100 per ounce, one day after a 6% decline that marked the sharpest sell-off in 12 years. The precious metal is still up 54% year-to-date after the correction, which our crowding model accurately presaged late last week. Investors who are invested in gold miners to proxy gold in their portfolios should use this correction as a reminder to beta adjust their positions appropriately. For example, GDX's beta to the spot price of gold is 1.5 on a trailing 6-month basis. That means investors using GDX to proxy gold must divide their intended gold exposure by 1.5 to achieve the appropriate position size. In our view, Treasury bonds remain the most mispriced core asset class in the world, and the year-to-date surge in gold and gold mining stocks reflects investor consensus becoming aware of this mispricing from an institutional portfolio construction perspective. Recall that we accurately forecast these structural flows when we pivoted our flagship investment strategy, KISS, from 30% core U.S. fixed income to 30% gold a year ago. Despite recent corrections in gold and crypto, the underlying speculative fervor at asset markets persists, as evidenced by the volume on betting exchanges Kalshi and Polymarket exceeding $2 billion in notional trading volume for the first time last week. The underlying speculative fervor in markets persists likely due to the uptrend in global liquidity, which our global liquidity model currently signals is likely to accelerate significantly over the medium term. Lastly, early data from Q3 earnings season indicate the strongest domestic corporate performance in 4 years, with 85% of reporting companies beating expectations, with about 20% of S&P 500 constituents having announced results. As we accurately presaged when outlining our paradigm C theme back in April, U.S. macroeconomic and microeconomic data are persistently beating consensus expectations due to the persistence of the underlying drivers of our 3-plus-year-old resilient U.S. economy theme. As always, our global investor community, Team 42, can trust that our institutional-grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying solely on fundamental research amid a deepening fourth-turning poly crisis, AI, and other factors. Transitioning to our 42 macro dashboard, as always, a wrap up with the question from our community. This one's titled ATH this week, slide 56. It says, hello, DD. This slide seemed important. Would you please expand on what you briefly said in your video on Saturday? So let's click on the slide. So the headline reads, in our data-driven view, the Powell Fed has a dangerously low level of awareness regarding the impact that its balance sheet has upon the economy and asset markets. Let me read that again. In our data-driven view, that's supported by 50 to 75 slides of research every single day in our leadoff morning note, 75 to 100 slides of research every Saturday in our Around the Horn, and 150 to 175 slides in our monthly macro scouting reports every month after the jobs report. So in our data-driven view, the Powell Fed has a dangerously low level of awareness regarding the impact that its balance sheet has upon the economy and asset markets. So the chart here on the left, so both charts show what we consider to be the aggregate U.S. monetary policy setting. So what the chart indicates are the blue line in both charts indicate the 5-year Z-score of the Fed funds rate as a proxy for how tight the Fed funds rate is relative to the cyclical credit cycle. And then we show in the chart on the left, the Fed balance sheet, the GDP. We show that on a 5-year Z-score basis, and then we invert that because obviously when the balance sheet is high, it's good, and when the balance sheet is low, it's bad. And that's the inverse in terms of the impact that the Fed funds rate has on the credit cycle. And so the black line just shows the arithmetic mean of those two 5-year Z-scores, including the inversion of the Fed balance sheet to GDP ratio to kind of create a amalgamated a sense of the U.S. monetary policy setting. So we got this idea from Zabert Zervos back this summer. And so what it shows is that the Fed's aggregate monetary policy setting, when you factor in the Fed's balance sheet to GDP ratio, which Zervos likes to use in his analysis, that is 1 sigma relative to the trailing 5-year. It's a Z-score of 1 relative to the trailing 5-year sample. This is much tighter than the Fed funds rate itself, which has obviously come down in recent years and is starting to come back down again now this fall. And so the investors need to be aware that this +1 setting is historically, not quite historically consistent with recessions, but pretty close. When you factor in other balance sheet dynamics here in the chart on the right. So that's the Zervis indicator. Sorry, before I go to the chart on the right. The chart on the left, the black line, and the chart on the left, we call that the Zervis indicator. The chart on the right, the black line, features a few more indicators of the balance sheet. And the reason we feature a few more indicators of the balance sheet is to overweight what we call the Dell indicator, which is the black line in the chart on the right. We want to overweight the Dell indicator for the balance sheet. And the reason we're doing this is because we believe ever since the trend of the credit cycle stopped being driven by the private sector and started being driven by the public sector shortly after the GFC, that means the balance sheet is more important. When the credit cycle is being driven by the private sector, the Fed funds rate, the level of the policy rate, and interest rates are the biggest feature in terms of determining the accelerations and decelerations in the credit cycle from a debt service perspective, because corporations default. Sovereigns don't default, generally speaking, don't default. If they default, it's usually with inflation, not with actually not returning your principal. And so as a function of that, we think the balance sheet dynamics, particularly the portfolio substitution effect that the Fed and other central banks have propagated in this post-crisis era, we think those dynamics are more important in terms of gauging the aggregate policy setting for not just the Fed, but for all central banks. So that's the reason we introduce all these incremental dynamics into the calculus. So these incremental balance sheet metrics into the calculus. So in addition to having the inverted 5-year Z-score of the Fed balance sheet to GDP, we also have the inverted 5-year Z-score of the Fed balance sheet to total U.S. financial assets outstanding. And we also have the inverted 5-year Z-score of the Fed's total SOMA portfolio divided by the total of marketable treasury debt and U.S. total residential mortgage debt outstanding. So again, that's just purely designed to overweight the balance sheet in this analysis in terms of trying to gauge the U.S. aggregate monetary policy setting. And as you can see in this chart here, this 1.3 metric is, if you draw a line straight across the top or straight across from the latest value, it is pretty consistent with how tight the Fed's policy is on an aggregate basis heading into recession. Now, again, we maintain our resilient U.S. economy theme, which we authored back in September of 2022. See no reason to get rid of that theme. So what we've been calling for and appropriately helping our investors position for is this U-shaped economy dynamic. And as we always forecast, the bottom of the U-shaped economy is likely to be sometime in the second half of 2025, specifically Q4 specifically. And so as we are approaching the bottom of the U-shaped economy, the data that are going to be reported to highlight the bottom of the U-shaped economy on a lag are likely to give the Fed a window in which to continue easing monetary policy. So we expect the Fed to continue easing monetary policy. We think that they are appropriate in truncating what we had identified this summer as the Powell Fed's fifth major policy mistake in terms of their reluctance to ease monetary policy in the face of a very obvious sharp deceleration in the labor market. And they're correcting that mistake in the U-shaped economy that we are currently kind of traversing the trough in, at least according to our math and our models. The U-shaped economy does afford the Fed a window in which to resume to continue easing monetary policy. So we expect the rate cut next week. We expect the rate cut in December. In fact, we can make the case that if the labor market continues to slow on a lag to this bottom of the U-shaped economy, which is consistent with how the GDP and labor market cycles have historically developed, then you would ultimately expect more easing in the first half of 2025 than this percent perhaps currently priced in. So just be aware of that. So we'll wrap it up there. Darius Stout here presenting our macro minute for Wednesday, October 22nd, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.